Okay, we are live, and today we are going to learn how to attract passive income in your life by investing in the correct mutual funds. This is an auspicious day today. 1st of August is a very beautiful day. It's a very auspicious day. It's a good number one. It's a Tuesday, and most importantly, it's a full moon. So, on this auspicious day, it's a beautiful time to actually learn about how do you increase your passive income by investing in the right mutual funds. How many of you would love to type in money in the chat window if you want to attract passive income? Because even when you write down the word money, it has its own vibrations, has its own frequency, which you're generating on the chat. So, let's go right now. Let's see how many people here are typing in money in the chat window now at full speed. Now, who is going to teach you about mutual funds? Me? No, not me. My name is Mitesh Khatri. I am just a law of attraction trainer. I've been doing this for about 20 years now, and my wife together. This is our book, The Law of Attraction. My job is not investments. I do investments, but based on the guidance of the best people in the world. And one of the best trainers in the world I know who teach people how to invest money, how to attract passive income in their life is a man whom I look up to personally, someone whom I learn from myself, someone who's a coach on my panel in our organization together. He is called as Modit Messi. So everyone, please type in the chat window. Thank you, Modit, for being part of our course today. Thank you, Modit, for being part of our YouTube channel. It's been an absolute pleasure to have you one more time on YouTube channel, because the last time you came, people had a great time. People learned a lot. People have been wanting to get more of you. So all of you, please type in thank you for Modit for being with us today. It is very difficult for him to be here, by the way. I want you to know that before I give over the mic to Modit right now, because Modit, what's the time over there?
Well, the time here is right now exactly 4:34
All right.
a.m.
So he's in New Zealand, Auckland right now, and the time there is 4:34 a.m. सुबह के 4:30 बजे हैं, and he's waking up there just to invest time with us and to give us this beautiful learning on an auspicious day of 1st of August. We insisted on that, and thank you to him for accepting that invitation. So all of you, please say thank you to Modit for that. So Modit, once again, thank you so much for accepting this invitation to us and giving so much knowledge and wisdom to our community one more time. Over to you, Modit.
Thank you so much, Mitesh, and it's always lovely to have these interactions. I think I also learn a lot of things because when I'm teaching, I'm not just telling you guys; I'm telling myself as well what is the right thing to do. So yeah, thank you so much, and hi everyone. My name is Modit, and I have this community called the Freedom Investors Hub, and we have this little amazing partnership with you guys, Law of Attraction magicians, right?
Yes.
So it's amazing that you are attracting so many good things in your life, and I'm just contributing a little bit by telling you where you can put the money to work,
So
right?
we
So
can
you can
attract
attract
more of that.
yeah, of course, you can attract money in your life. Where do you put it to work is something that I hope I'll be able to help you. And today's session would be on mutual funds. So,
Perfect.
yeah, let's get started now. Yeah.
So, Modit, if you could help the audience understand, before we do that, all of you please type in R for ready if you're ready to understand how to invest in the right mutual funds in life so that you can attract a lot of money. On behalf of all of you, I'm going to ask two important questions to Modit, sir. So, Modit, question number one is, what is the difference between investing in, let's say, a fixed deposit versus, because fixed deposit seems like so safe, right? Versus a mutual fund, how safe it is, how risky it is, and what's really the difference between both of that?
Yeah. See, the general perception is that mutual funds are risky and fixed deposits are something that gives you safe returns, stable returns. So they are much more better. But the thing is, over a long period of time, you would see fixed deposits are more risky. And I'll tell you why. Because of
Okay.
inflation.
Hold
So
on. Did
when
you
you
say if you fixed deposit are more risky?
yes,
That's crazy. Okay, I want to hear this. How many of you want to hear this? Type in now in the chat window because I really want to know. I've heard it for donkey years in my life. Like since the time I'm born, I think everything I heard about investments was FD mein paisa dalo.
yeah.
And here you're saying it's more risky. Please explain.
That's because see, earlier maybe if we go back 10, 15, 20 years, the returns that we used to get in mutual in fixed deposit was 10, 12%, but now it's not
Correct.
even 6%. So if you look at after tax return, if you're getting 7.5% return, after tax will be closer to 6%, which is not even beating inflation. So what's happening is you are losing money every year. So if inflation is 8, 9, 10%, right? And we're not talking about the headline inflation that you get to hear in the news. I'm talking about inflation that really pinches us. It can be the food inflation, it can be the education inflation that's growing at 8, 10, 12, 15%, especially if you look at education and other
Education.
things. Yeah. So 6% is not gonna cut it for you. You need more returns. And for time being, it may seem safe, but 5, 7 years down the line, you'll realize that your money has lost value. And that's why investing in mutual funds, which can give you better returns, and of course the risk is there, but the risk can be brought down by, you know uh, by looking at a long term horizon. So when you're
Wow.
investing and you're looking at 5, 7, 10 years, then you'll get good returns. And today we learn how to identify and select good mutual funds.
Awesome. So my second question to you would be, by the way, how many of you found that amazing? Type in amazing in the chat window that fixed deposit, as he explained, if you check inflation, what is inflation? The country, the money that we are expending every year, whatever we are spending on is getting expensive. Everyone type in yes if you agree. Things are getting expensive year after year. The education is getting more expensive. The petrol is getting expensive. The food is getting more and more expensive. So that's inflation. So what it's saying is that if you deposit 1 lakh rupees in the fixed deposit today, you get 6%. But the inflation, which is the expenses, are growing by 8% every year of the things that we are buying. And then after you pay taxes, what you get in your hand in the fixed deposit is less than what you're actually invested in the first place. And plus the inflation is there. So actually, fixed deposit is more risky. That's crazy. So everyone type in amazing if you found that amazing knowledge. Now, the second question, Modit, is when we start investing in mutual funds, before we understand how to select the right mutual funds, what would be the right period that we need to be invested in a mutual fund? Because a lot of people have this misconception that, okay, I invest into mutual fund today, and after 6 months, if my money is going down, then I made the bad decision of investing. So in 6 months, my money should give me 15% return or 20% returns. What do you have to say about that?
Well, when we're investing in mutual funds, especially the equity mutual funds, it comes with risk. If you invest your money with a short term horizon, let's say 6 months, 12 months, then there's a good chance that you actually may lose money as well. Because you never know, if you invest and the market goes down tomorrow, of course, the value of your investment will go down. But if you're looking at 4, 5, 6 years kind of a time horizon, longer the better, you will be able to make money, because then you'll account for the ups and downs in the stock market.
Wow. So how long should we look at?
Should be 5 years and above, especially in
5 years and
equity
above.
market. Yes, because see, if we take the latest example, if you look at the last few years, pandemic happened. Nobody expected that, and if somebody invested in 2019, or let's say in January 2020, the market went down by close to 40%. So
Right.
imagine if you invested 10 lakh, and the investment is now 6 lakh rupees. Of course, it'll be it'll ring alarm bells. But look at what's happening now. After 3 years, that investment would have grown many folds over. You would have at least
Right.
doubled your money in 3 years, even after that pandemic. So the longer the time horizon, the better. At least 5 years. And if you're looking
Okay.
for debt mutual funds, then yeah, around 3 years or more.
Okay. So at least 3 years, but definitely 5 years or more if you're looking at stocks.
Yeah. So stock market, there is equity market, 5 years or more. Debt should be 3 years plus.
3 years plus. Got it. So, what are the criteria that we should look at when we are selecting the right mutual funds? Because right now, all I think most of us know about mutual funds is go to our bank manager, ask the bank manager, where should I invest? Most of us have zero knowledge about investing, where to invest in the right mutual funds. And then if the fund manager says, or I'm sorry, not the fund manager, if the bank manager says, or my investment manager says, put the money here, then I feel, okay, he's the expert, so I put the money there. But I remember I learned this from you that you be more knowledgeable about your money, about where you're investing versus blindly believing in your bank manager. Is that right?
That's right. In fact, if you follow your bank manager, your relationship manager, what will happen is uh, they will invest your money at a place where they are getting more commission. It's not that they want your money. They don't want you to lose money, but just because the incentive for them is to get more commission,
Oh,
even if the mutual fund or the investment is not that great, just because they're getting more commission, they will pitch you that product.
wow.
Unless you understand this, that the the really the heart of the matter is that if you follow your bank manager, most likely you will not be able to get better returns. If you
Wow.
manage your money on your own, if you learn, and learning would not take much time, you will be able to do better, and you'll be able to grow your money faster. And I'll tell you, today we learn by which you'll be able to select mutual funds in about 5 minutes.
Select mutual funds in 5 minutes?
Yes, it won't take
Wow.
much time. Today we'll be learning that.
Wow, that's a little more than two Maggie noodles. I love that. Okay. How many of you are ready for 5 minutes of learnings of, well, the learning may take a little more time, but once you learn it, he's saying that you'll be able to select the right mutual funds in 5 minutes by learning what you're learning today. So are you ready, everyone? Type in ready again in the chat window. Let's go, Modit sir. What are the criteria that we can learn that can help us select the right mutual funds in, I think, less than three Maggies? 5 minutes.
Let's learn. Okay, and it's really simple. And since all of you are here to learn, the first thing I want you to believe is that it's not difficult. It is
Okay.
not. You can easily learn it, right? And practice it. The only
Okay.
thing that you need to have is long term horizon. And we'll go through the filters that you need to go through when you're investing. So let's get started. Yeah, so I'm gonna share my screen now. Okay,
Done.
and let's start learning. Okay, right. Okay, okay, so I'm gonna share my screen now. uh,
So once you share your screen, I'll be able to see it and then I can add it on the screen there.
okay, lovely. Right, so just give me a second here.
Yep. In the meanwhile, while he's getting his screen ready, all of you make sure that you have a notepad and a pen ready because the things that he's about to teach you right now are very important things that we must be educated on. Listen, if you want to attract money, type in yes in the chat window. But then, if you want to attract money, you must understand and learn the language of money. You can't say, no, I don't understand the language of money, and you also attract money. It's not possible. Along with affirmations, your action frequency is also important. So it's important right now that based on your actions, you upgrade your knowledge, you upgrade your frequency about how money works in the mutual fund market so that you're able to actually attract it by making intelligent decisions, wise decisions, most importantly, your personal knowledge decisions. So take your notepad, take a pen quickly, make some notes. Okay, here we go.
Awesome, so let's get started. Okay, I'm gonna share my screen now. Right, you should be able to. Yeah, okay, right, so
Yep,
all set.
we can see it.
We'll be
Yes, go ahead.
You should be able to see it now. Yeah, awesome. So
Absolutely.
we've been looking at this website, quite a good website. It's called Value Research. I'll tell you what all to look for, right? But to start with, as an investor, what are the options that you have when you want to invest in stock market? One is that you invest your money on your own, select shares or the companies that you think can work better for you. However, if you're starting out, I would recommend that you don't go for direct investment because it can be risky as well. And selecting the right kind of companies may not come easily initially. Later on it'll become easier as well. So the best thing to do would be to start with a mutual fund. Now, what is a mutual fund? Mutual fund is, people pull in money and they hand it over to a fund manager, and this fund manager will manage this money. So what the fund manager does is, so this fund manager will get the money and he would invest the money into different companies. So you are not selecting the companies because you don't have the experience. It's the fund manager who's doing it for you. And will he be doing it for free? What do you think? No. He would obviously charge for it, right? And there is a fund management charge that you would need to pay. We'll go through all that. But this is what you need to understand, because you are not a sophisticated investor right now. You are investing in mutual funds and there's nothing wrong in it. The money goes to the fund manager. There is a charge for it, half a percent, sometime 1%, it can be 2% as well, right? And your money gets invested into the stock market. So ultimately the money is getting invested in the stock market. People think that, okay, I'm investing in mutual fund, so it's better than stock market, at least it's safe. No, your money is still getting invested in the stock market. The only thing is, you are not managing it. It's the fund manager who is managing it for you. So how do you select the mutual funds, right? So, couple of points that you need to understand is that first is your time horizon has to be longer. Whenever you're investing in equity market, it should be 5 years or more, and you should be investing in a staggered manner. You should not really put all of your money in one go, because if you're lucky, then of course, yes, if you're lucky, you'll be able to invest right at the bottom and you'll do well. But there could be a chance that the moment you invested, there was the time that the market started to go down and your investments will start to see losses, right? So we don't have to depend on luck. We have to be, smart about money. And if you're so lucky, like I always say, then rather than investing in mutual funds, I think we should be heading to Las Vegas and putting our money there because we are
That's a
lucky,
good
right?
one. That's a really good one. If you're so lucky, you might as well invest in the actual gambling business.
Yeah, absolutely. So since we need to take care of the risk, invest for long term, invest in a staggered manner. Now, what is staggered manner? Don't invest all of your money in one go. Break it into smaller pieces. So let's say you have 5 lakh, 10 lakh, 50 lakh rupees to invest. Break it into smaller pieces. Let's say 10 lakh, maybe you can break it up into 3 to 4 pieces. You invest a couple of lakhs every time when the market goes down. Or if you have a bigger chunk of money, then maybe break it into 10, 12 pieces. So let's say 50 lakh rupees or a crore that you want to invest. Break it up into 10, 12, 15, 18 parts and invest in a staggered manner. So this way, you will be able to average out. And since you would have a longer term horizon, 5 years or so, you'll be able to double your money. And how do you find out, how much time it'll take you to double your money? So there is something called rule of 72. I think you should be able to see this, right? Okay, so rule of 72, what does it
Yes, we
say?
can see this.
Okay, thank you. So, rule of 72, what it says is that if you want to find out how much time it will take you to double your money, you simply divide the number 72 by the rate of returns that you're getting. So, 72, let's say if you're getting 16% return, then in about 4 to 5 years, you'll be able to double your money if you're getting around 16% return a year. Now, has stock market given this kind of returns? Yes, it has. So, if we take a look at Sensex, Sensex is an index. It has been around for more than 40 years. It was launched in 1978, and the base value then was 100, right? And by the end of 2022, it was around 60,800. That means it went up by how many times? More than 600 times, right? Look at this. This divided by this. So more than 600 times it went up, right? Now, if we calculate how many number of years, so this minus this, that means in about 44 years, it went up by 608 times. What does this mean? What is the average return every year? So we can calculate that too. So let's look at that. In about 44 years, what has happened is 100 rupee has become 660,000, right? 60,800. That means what is the rate of return that we got approximately every year? So that's 16%. So that means Indian stock market is doubling our money every 4 to 5 years. So if you have 5 years time horizon, that's good enough for you to double your money, right? There will be ups and downs. You probably be able to make more money, maybe 18, 20%, or probably be able to get lesser than 16%, 14%, 13%. But 16% is the average number, right? And that should make you pretty happy. And as you learn more, you'll be able to earn more. But 15, 16% for someone who's just starting out is pretty good, right? So now let's go back here and let's now talk about how to select mutual funds. So this is a website that I used to use quite a lot when I was investing in mutual funds. I don't do that anymore, uh, because I'm directly investing in stock market now. Yeah, but this is the website that I used to use earlier, right? 10, 12 years ago, right? So how do you select good mutual funds? So first is, even if you have zero knowledge, right, and you do not even know about the names of the mutual fund, it's absolutely okay, right? What you need to actually understand is that when you're investing in equity mutual funds, right? Equity mutual funds, there can be a large cap, which is big companies. Investing into the big companies, these mutual funds are called large cap mutual funds. Then we have mid cap mutual funds, which is investing into medium sized companies. And then we have small cap mutual fund, right? And I think you can pretty much guess where would be the highest risk. So would it be in the large cap, mid cap, or small cap? Of course, I think you know the answer will be small cap
Small
and
cap,
then mid.
because the smaller companies are the ones which are more risky, right?
Yes, absolutely. The
Right.
price volatility is much more, right? Large cap, they are big companies, established company. They will give you stable kind of returns, somewhere around 15, 17, maybe 20%, right? But these companies can give you higher returns, or these mutual funds can give you higher returns, and there is a higher risk too. And since we want to reduce risk, we would reduce our investments here, right? It has to be a mix of everything. You can't just be putting your money here because it gives better returns. There is risk as well, right? So you need to understand that, and we need to have the right kind of mix. So let's say you have no idea, but you just know that, yeah, there is large cap mutual fund, mid cap mutual fund, small cap mutual fund. And let's
So can I
start with
say,
the
Mudit,
large
when you
cap.
say large cap, mid cap, small cap, so can I simply say as large companies like Infosys,
Yes.
and mid cap would be, I don't know, medium
You know,
companies like,
yeah, it can be a medium company like Persistent. That's an
I
IT
see,
company. Yeah. And small cap would be probably those names that we have not heard of,
not
right?
heard
And
of.
they are
Okay, great.
listed companies. They're listed companies. Some of them are, could be fake companies as well. So there is risk. The element of risk is highest here in the small cap. So that's why we need to have a mix of it, and can't really be putting all our money here because that's asking for trouble. It can again give you great returns if you're lucky, but then again, we don't have to depend on luck. So now we know large cap, mid cap, small cap. Now we don't even know the names of any fund right now. Okay. How do we select the mutual fund? So let's get to that now. So what you can do is go here on this website, the search bar, and just simply type large cap. I'm telling you how to select mutual fund, right?
Wow.
Yeah. So when you select this, you'll get these options here. Let's say you go for Nippon India large cap fund. You know nothing about it, and this is like your first step, right? And you are looking at this this Nippon India large cap fund. The only thing you know is that it's investing in the large companies. Now you can start to see some information about it, right? First is it'll show you riskometer, which is very high. Now you don't have to be too concerned about it. The only reason why it's saying very high is because you're investing in equity market, and the risk is always high in equity market. This should not really uh, evoke fear in you. When you're investing in equity market, investing for long term, investing in Indian stock market, Indian economy is growing, so there's nothing to worry about. Okay, again, the only two things that you need to remember is stay invested for long term, 5 years or more, and invest in a staggered manner. That's about it, right? Another thing that you look at is the value research rating. If it's 4 or 5 star rating, then yeah, it's a good fund, right? But we would not just rely on this. We would do our own analysis as well, and let's start doing that. So it's showing us that the 3 years return has been 31%. Now this is per year. This is not in 3 years 100 rupee has become 131. It's 31% every year. So again, going back to this rule of 72, if somebody is getting 31% return, that means 72 divided by 31. That means the money doubled in less than 3 years, right? That's pretty good, right? So it's doing well, nice, but we would not just rely on this. We'll look at the short term performance and we'll look at the long term performance as well. So you can get to see that here, right? We'll look at the last 1 year return. Now, if you look at the last 1 year, stock market has gone up. Most of the companies have given good returns. Mutual funds have given good returns, but we are just not looking at a short-term window here. We're looking at long-term as well. So we're looking at 1 year. We just saw 3 years, and 3 years ago we had pandemic, so the base is also lower. That's why you have better returns right now. But we look at long term view here. So 5 years is 15%, which is again in line with the the average return that the market has been able to give. 5 years, let's say 7 years, it's around 15%. Consistency is there, so that's something which is good. Now we can even look at this chart here. Now this is comparing the mutual fund with a benchmark. This is the equity large cap benchmark, and it has been able to beat it in the last 1 year. In last 3 years, let's say if it was able to beat it. Yeah. And in case if you have any questions, Mitesh, you can always come in and ask
Absolutely.
me that.
So, as you said, Modit, the first point was to look at the 3 years or 5 years, short term and long term, for value
Yeah.
research online.com, correct?
Yeah, that's right.
We look for an example, the large cap fund over there. We found Nippon India. We looked at the 3 years returns. And now we
Yeah.
are looking at the second criteria. What is the second criteria?
Second criteria is we're comparing it with the benchmark. Now, what is a benchmark? So benchmark is you're comparing it with the other, an average of the other schemes, you can see, right? So here this has done better. With this one is blue, and you see that it's kind of outperforming S&P BSC 100 TRI, right? That's total return index, and the equity large cap index, just like Nifty is a combination of 50 companies. So there is
Wow.
another index here, which is a large cap index, and it has been able to beat that in 3 years. Let's see if it was able to beat that in 5 years. So what Nippon India is doing, it's able to do better than the average, right? Average is mix of all the large companies, the equity large cap index, right?
So,
Okay,
Modit,
can
it's
you?
actually possible that mutual funds can beat a certain specific stock of a company in terms of how it grows.
Yeah, of course. See,
Wow. That's knowledge for me. Amazing.
yeah, last 1 year return is 26%. And in case if there's a company which has given 15-20% returns, of course, and there won't be much companies giving better returns in the large cap space, a return of
Right.
around 27% in about 1 year, right? Then you can go
Wow.
down, you can calculate how much you would have made if you would have invested 10,000. You can change this. Let's say you say 5,000, right? Upward investment, and you were ready to put 15,000 uh, every month, right? Investment horizon 10 years. It will calculate how much your amount would be, right? In about 10 years, you can change this period to, let's say, 5 years, right? The longer you wait, the better compounding you get, right? Because
Right.
again, rule of 72, you'll be able to double your money faster. So if you're able to double your money in about 2.3 years and you stay invested for 10 years, then how many doubles you get, right? You get around four doubles.
Four
So
times. Oh,
one
wow.
lakh, yeah. So your 1 lakh grows 4 times. So 1 lakh becomes 2 lakh, then four, then eight. Likewise, more you stay invested, the better returns you get, and you can actually see that here as well. So 5 years, you're just getting 15 lakhs, and 10 years, look at the difference it makes. 43 lakhs, right? And the longer you wait, the better it is. 5 years is the minimum I'm talking about, right? Yeah, so I think it's not not accepting 15 years, but that's okay. You get the idea, right? Now if
Correct.
I go down here, it again shows the risk. It doesn't matter. You're investing in equity market, it would always show you high risk, so it doesn't matter. Don't get too perturbed about this. Yeah. And then it'll also show you the portfolio breakdown. We'll get to that in a bit, but yeah, this is important. Now, we had no idea about the names of the mutual fund. The only thing that we knew was large cap, mid cap, small cap. And we started with typing in large cap and we got one mutual fund. And now we have a peer comparison. So now what it's doing is it's comparing your mutual fund with, or not your mutual fund right now, but this mutual fund with the other mutual funds in the same category. So that's important. You don't have to compare
Wow.
large cap with a small cap, right? Compare apple with apple only, right? Not oranges. So large cap returns for other mutual fund schemes, right? So here, Nippon India, the one that we selected initially, in last 1 year has been able to give 26%, right? And if you look at the other mutual fund, which is ICICI, SBI, all these mutual funds have been able to not beat this return. Now, again, don't get me wrong, I'm not chasing the highest return. because that's never a good idea. Don't chase the highest giving return, that okay, this one is giving the highest return, so this must be good, right?
Oh,
Select something which is consistent, right? Not that giving 26% 1 year, but if you look at 3 years, it's languishing at 10%. That does not make any sense, right? But we would
wow.
not
So I
really.
want to repeat that. You're saying focus on consistent mutual funds that are giving
Yeah,
consistent returns rather than highest returns, because a mutual fund can give 30% in 1 year, and maybe it's not consistent in the next year, maybe it gives less. Is that what you're saying?
absolutely. And
Wow.
the number keeps changing. You're looking at number one right now. This one maybe is at the top. Maybe after 1 year, you probably see ICICI doing better. So what would you do now?
Awesome.
Would you sell Nippon and buy ICICI? That does not again make sense. When you invest, first investigate and then invest. And once you've invested, stay invested for 5 years or more. You will most likely be able to make wealth for yourself, right? And 1 year is not the only time period that we look at. We look at, let's say, 3 years. Let's say what this fund has done in 3 years. See, everything has done well in the last 3 years because of the pandemic. The markets were down, and of course, the markets are up right now, near an all-time high. So yeah, it is gonna show you great returns, but this one is still outperforming, which is again good. Now let's look at the long term. Let's look at the 5 years return. It is again, you know, doing well. So that means this fund is consistent. It's consistent, and it's consistency that we are looking for. And something which is consistent should be able to make money for you. It'll be able to smoothen out the good times and the bad times, and will give you average and above average return, especially if you stay invested and invest when the market goes down. Look at this. If you invest more when the market goes down, you'll be able to get more returns, right? So yeah, by looking at this, it seems that Nippon large cap is a good fund and it can be invested, but there are other
That's right.
criteria. Yeah, there are other criteria too. So
So
we'll
Modit,
get
we've
we'll
seen
get
three criteria so far. Criteria number one is we go to this website and we
yeah,
look for the large cap funds. So we always
yes,
look at the data on a legitimate website like this rather than just talking to friends and bank managers and stuff like that. We do our own
absolutely,
research. That's step number
yeah,
one. Step number two, we come here and then we look at a benchmark of this mutual fund with some of the companies that it's been beating. Step number
yeah,
three, or criteria number three, is by going to the bottom level of the screen as you were showing and looking at the comparison of that large cap mutual fund with the other large cap mutual funds, and not necessarily looking for the highest giving return mutual fund, but the
yeah,
most consistent running return over a period of 3 years, 5 years, and ahead. Is that right?
absolutely. Great summary.
Awesome.
Thank you so much for
Awesome.
that.
Ready for step four. Everyone type in four if you're ready for step four. Go for it, Modit.
Awesome. Awesome. So let's look at the other criteria. And return is one thing, and probably the most important thing, because if our investments are not making returns in the past, most likely the fund manager is not able to do justice with the money that he has, right? So that's the most important part, but that's not the only part. We'll also be looking at the expense ratio. Now, what is this? So remember, I told you the fund manager is not doing it for free. There is a charge for it, right?
That's right.
And this is that charge, expense ratio. So 0.94% is what it's charging. Now you got to remember that even if, let's say, the market goes down, you are losing money. Your investments are going down, but the expense you'll still have to pay. So it's better to go for a mutual fund which is not charging too much. And there's a fine balance. If it's able to deliver well and charging a little bit extra than the average, it's okay. But if it's not performing but charging more, of course, there is a mismatch there, then we would avoid such fund, right? But this is charging 0.94, which is quite okay compared to ICICI. It's quite comparable, right? Mirai has been able to, charge really less, right? Which is good. But let's say if we were convinced with this, there's nothing wrong in investing, in a mutual fund which is charging slightly more than maybe some other mutual fund which is available at a lesser cost. But if you can get some bit of outperformance, then it's okay paying a little bit extra, but just a little bit, not too much, right? So there's another criteria. We look at the expense ratio, and this again will help us decide which one to go for. So let's say if Mirai and Nippon, they both were performing almost equally, right? You look at the short term, Nippon has been able to outperform. But if we assume that both of them were performing equally well, almost same, then expense ratio will be able to help us decide which mutual fund we should be going for, right? So that's another criteria that you need to actually understand. And then you can also be looking at some other things, but there is this portfolio tab as well. So when you click on this portfolio tab, it'll be able to show you where is it investing, right? Giant cap, large cap, it's also investing some bit in the mid cap as well. But people go down here as well to see where exactly they're investing financial energy. All this is fine, but if you go down here, you'll also be able to see which mutual funds, rather, which companies they are investing in. So they are investing in Reliance, ICICI, HDFC. Now, so the point is, you don't have to take a call on whether the investment in these companies makes sense or not, because see, when we are investing and we are investing for the first time, we don't have much knowledge. We can't really be taking a call on the portfolio mix. What kind of company should be included and what kind of company should be excluded? Because if we are good at doing this, we should not really be investing in mutual funds. We should rather be investing our money directly in the equity market, directly buying Reliance, ICICI if we feel that these are the good companies. However, we are investing in mutual fund because we don't have the time to manage the money, maybe we don't have the knowledge to manage the money right now. So it's better to not get into analyzing the portfolio, because it does not make sense. We would simply look at the other parameters and let this the managing of the portfolio be something that fund manager will take care of. So you can have a look if you want to, but you don't have to judge that, okay, this it has Tata Motors, so I won't invest here because I don't believe in this company. You don't have to think like that. You just have to look at overall return, look at the expense ratio, look at few other things as well. So portfolio, yeah, it's good if you want to go and have a look, right?
So,
But you
Modit,
don't
can
have
you
to take.
simplify the expense ratio a little bit more for people who wouldn't be able to understand expense ratio again? Like,
Yeah,
if you could
sure.
give us a metaphor or an example.
Sure. So if we go back to this screen, we would see that the expense ratio here is 0.94. So let's say if you had invested 1 lakh, okay, and that 1 lakh after 1 year is now 1,20,000, right? You got 20% return. So 0.94 of that 1,20,000 will be deducted, and the mutual fund company, which is called AMC, Asset Management Company, AMC, they will get it, right? Now let's say next year something happens and the market does exceedingly well, and in about 1 year the money doubles, right? And now that 1,20,000 is 2,40,000. So that 0.94 will be applicable on that 2,40,000. So every year, whatever amount that you have invested, this amount will be charged 0.94%. And it won't be just one off, it'll be charged every month, right? So it'll be divided by 12 and will be charged from your investments, right?
That's
So
right.
yeah, I hope you got that now.
Yeah,
Yeah.
now we got that. Everybody got that. Type and got that in the chat window now. We've even done the summary of the 5 steps in the chat window. Please continue with it.
Okay, perfect. So, now what we can look at is we can also look at, few other things. Now, this will give you the basic information as to, about the mutual fund scheme. It'll tell you about what is the benchmark, when was it launched, whether it's an open-ended or closed-ended. Now, what is open-ended, closed-ended? Open-ended is you can put your money anytime and you can withdraw your money anytime as well, right? There's no lock-in period. There are closed-ended mutual funds too. Um, you'd see the bank manager selling these kind of funds quite a lot. The reason is, again, they get more commissions out of it, and that's why they would want you to lock in your money, because once your money is locked for 3 years, 5 years, it guarantees them that expense ratio for those number of years, and that's why
Wow.
they're willing to offer more commission to the salesmen so that they get money and they lock in that money for a couple of years, right? So again, the incentive is different. Your incentive is to make more money and pay less, right? And be you should have the freedom to take out the money. Let's say if the mutual fund is not doing well, you should be able to pull out your money anytime, but that's not the case if you invest in a closed ended fund. So always just keep it simple. Just invest in an open ended fund. If you're saving for tax, then again it'll be a closed ended fund because there's a cap of 3 years there. And the reason why the government has put a 3 years cap is so that people stay invested and they'll be able to make money, because 3 5 years is a good enough period, right? By at least 3 years your money would be locked when you're investing in a ELSS, the equity linked savings scheme, right? So you'll get to know a few more things. And if I go down here, you'll also get to know who's the fund manager. Now, this is again something which will give you some quality information about whether you should be investing in the fund or not. So this fund manager has been managing it since the beginning, right? And you get to see some of his interviews. So you can go through the interview. You can click on it, go through the interview, just to understand, how this person thinks and whether it aligns with the way you think. And in case if you don't feel that you don't see that alignment happening, then maybe you can go for some other mutual fund, right? You would also get to see here on this page, apart from the interviews, you'll also get to see some other mutual fund schemes that this fund manager is managing.
Oh,
So this
interesting.
yeah, this fund is managed by two people here, Ashutosh and Shailesh, right? So you can go through, their interviews, some of the schemes. So, for example, let's say if I say uh, Shailesh is also managing this fund since March 2005. Now, that's a long period. Just to see how well this guy has done, we can also take a look at this fund. So, let's have a look at this fund, how well this fund has done. So again, last 3 years, it's a multi-cap fund. Now, multi-cap is they'll keep changing, right? So in case if they feel large cap may do well, they'll allocate more money towards large cap. If they think mid and small cap can do better, they'll move the money. So there's a freedom to choose which cap they want to invest in. A large cap would primarily be investing in the large cap. So you should really be investing in a flexi cap fund where fund manager can choose where to invest, right? So let's quickly analyze this as well. 1 year period 31, 3 years everything has done well, so we understand it. But let's look at the long term. 5 years 17%, which is pretty okay. 7 years, 10 years, has been able to give better returns. But again, we would be comparing it with the peers to get some understanding whether it was able to
I
beat.
was about to ask you that if it's 30% right now, suddenly in 10 years it's about 17 or 15%, then how do I really understand whether it's really because the moment you said 30%, that became like my benchmark in my mind that for the next 10 years or 15 years, it should actually get 40%, 50%, but it suddenly came down to 15. So is it good or is it not? How do I understand that? So I think that's what you're getting to in terms of benchmark of peers.
Yes, yes, absolutely. So peer,
Wow.
we'll have to
Continue.
look at whether the mutual fund is able to beat the market in long term, and whether it was able to beat the peers. Because let's say if you are investing in this fund, and even if it was able to give 25%, it's a great number. But let's say at the same time, same category, another mutual fund was able to give more returns, and let's say they were charging less as well. So it makes sense for us to go for that fund rather than this fund. That's why peer
Ah.
comparison is actually very important, right? So we can quickly go down to see this. So this is the Nippon India multi-cap fund that Salish is managing. Last 1 year return has been pretty good. Let's look at the last 3 years. Again, kind of pretty good. And we don't have many schemes in this category. We have only ICICI. Uh, let's have a look at the last 7 years. So it's quite comparable. Expense ratio is also on a lower side, so there's something that can be explored. And the fact that he's been able to deliver 15, 18, 19% kind of returns over a 10-year period, that means he's been able to do pretty well. Right now, we don't have to
Wow.
go by their rating always. We have to do our own analysis too. So this guy, when we analyzed this guy, he's been able to do well here in this scheme, Nippon large cap. And even in the multi cap, he's been able to do a fair job of 18, 19% over a long period of time. That
Oh.
is pretty okay. So we can say that, yeah, this fund is actually pretty okay.
So how do you know he's doing well with the other funds?
Yeah, so that's what you'll do. So what you do is the same. thing that we are doing here, analyzing this fund, we would analyze the funds that he's been managing. So when we go to others, we'll get to see which all mutual fund schemes he's managing. So let's say he's also
Ah,
managing Nippon India Pharma, or we can even look at Ashutosh. So Ashutosh is also managing, let's say, um, this is a fund of fund. Okay, so let's look at the Nippon Balanced Advantage. Now, balance would have investment into debt as well. Okay, so let's have a look at this fund, because since they are managing this scheme as well, and if they are doing well here too, that means the fund manager is able to do pretty well
that
all
makes
across.
sense. So it's as
Yeah.
simple as there is a CEO of a company and he's running three companies. We are looking at the company's performance over a period of 10 years of all three companies. And if the CEO is doing well in all the three companies, then he's doing fairly well in managing all the three businesses.
Absolutely, that's very well put. Yes,
Wow.
absolutely.
Thank you.
Look at the last 1 year return is 11%. Now, this is not just equity investment; it's a balanced. So that means it has debt as well. And when you have debt, because let me show you the portfolio mix here. When you have debt, there is the performance will actually go down, because your investment is also in the debt as well, right? Debt and equity. Debt is you are debt, as the name suggests, you're giving out loan to other companies. You are not doing it. It's the fund manager who's deciding which company is credit worthy, and they are giving out loan to these companies and giving and getting interest on that loan in return, right? So it's safer than equity, and since it's safer, the returns actually go down a little, and a combination of the two would be a balanced fund, right? And again, we look at the returns, but not in isolation. Okay, but has been able to do pretty okay,
That
10,
is new to
12%.
me that you can have a debt funds and a mutual fund balanced. That's actually new knowledge for me. All of you type in new if this is new to you that you never knew about balanced fund before. Thank you, Modi. This is amazing. But you're saying in the balanced fund, the returns could be a little lower.
Yeah, if you compare it with equity, of course it'll be lower, and there's a different need for it. So let's say if somebody is retired and they want to get better than fixed deposit returns, then they can go for something like this, because uh, it kind of gives you some tax advantage as well. You won't really have to pay 30% on it. That's the advantage, right? Now, if I go down here just to understand the peer performance, right? So again, we go to overview and go down here, and let's look at the last 1 year. So this one has done better, HDFC, right? 2 years return, HDFC is good, but this is kind of languishing at the bottom. You can see, 3 years return, again HDFC has been doing well. 7 years return, yeah. So you can say that this fund is able to do a fair job as far as returns are concerned over a long period of time. So we have this one which is giving better returns, but again, as I said, we don't have to chase the highest return, right? We can look for a decent mutual fund, and that should be able to do the job for us. The only thing that we need to look at is a gross underperformance. You can Such kind of a mutual fund you can avoid, and something which is charging way too much. And if you look at this fund, 1.79%, compared to HDFC is even charging lesser. So yeah, it's right up there. So maybe what we can do is, this fund is something that we may not go for, right? We may select something else because it's charging more, right, on a higher side, and it's not able to give a better return as well, right? Comparably, yeah, it's around at number two, number three. This is pretty okay as well, but you get the idea. So what
Wow.
happens is, we're looking at a mutual fund, looking at all the parameters, looking at the fund manager, maybe going through his interviews, and looking at the other schemes. And again, we don't
Right.
want the mutual fund to be number one in everything. If
Right.
it's able to do a decent job, then just because Indian stock market is growing, you will be able to build wealth for yourself.
Awesome. So if I kind of do a recap for us over there, Mudit, I've written a few pointers below. Let me know if I'm on the right track with you. First point is we go to value research website, that valueresearchonline.com. Criteria number two is we research large cap for 3 years, 5 years, 7 years performance. And when we say performance, what that really means is first we look at their 3 years, 5 years, kind of as you showed on the website, what returns they've given over a period of 3 or 5 or 7 years, right? And as you showed us, it's not necessary that just because in the first year it gave great performance, it may give in the long year of 7 or 10 years. Then the criteria three was comparing the benchmark against the market, especially
Yeah.
like NSE or BSE. How's it doing against that? Is it beating the market or not? And then comparing the benchmark with its own peers. Right below there in the website, you showed the other large caps which we were able to easily compare with. Then we were
Yeah.
looking at checking the fund manager fees to make sure that it's not too cheap, it's not too expensive, and it's okay to have a little higher fees like 0.94 of 1%, provided we know that the first three criteria are telling us it's beating the market, it's beating the market against the other peers also. Then it's okay. You're saying to go a little higher on the fees, which is about 0.95 or 1% that you were showing at that time. Then
Yeah.
we looked at going lower on the expense ratio. Did you say as low as possible?
Won't be as low as possible because quality you'll have to pay a little bit extra for quality, but then it should not be too expensive. Should be comparable. So let's say there is a fund that you like, but it's charging, for example, 0.94,
Right.
right? And the others are charging zero point 0.8, but they're not able to deliver as much. So it's okay paying a little bit extra rather than paying
Got that.
0.8%. You're paying slightly more, 0.14% extra, but that's okay.
Perfect.
But in
Perfect.
let's say other funds are charging 0.8%, but this fund that you like is charging 1.6%, then probably you can avoid it.
Makes sense. And then we look at open ended funds. So we don't necessarily try to go into closed funds, but really open ended funds. And the final point you said was the criteria number seven was check fund manager interviews, check the comparative. So basically, we do a little more research on the fund manager himself or herself
That's
in terms of what are the other funds that they've managed. And on the same website, we could look at their performance over a period of years, and then we can make a decision. That these are the criteria we covered. Wow,
yeah.
this actually looks easy now. Suddenly, it like if I practice this, I think we can do this in 5 7 minutes. Maybe first time it can take me 10 15 minutes, maybe half an hour,
Yeah.
right?
Of course,
But
then
do
it.
you think you can do this in 5 minutes now?
So let's do that now that we have we have you know analyzed one fund. Let's just look at some other fund. Let's look at a mid cap, large and mid cap kind of a
Done.
fund. Okay, I'm just gonna
Okay, how many
share
of you
my.
ready to learn a little more about midcap? Type in R for ready if you're still ready for a little more because you're learning the language of money. I mean, don't go away. Make sure that you're still learning with us. Okay, so one last thing we're going to learn about midcaps and how do we really understand the same thing that we've seen, the same benchmark and criterias. Maximum 5 minutes. Can we learn? Let's find out. Here we go, Mudit, on the next screen.
Okay, great. Yeah, so I'm gonna share my screen now. All right. Okay, let's have a look. Okay, so again, we'll. I hope you're able to see my screen. Yeah.
Absolutely.
Okay, lovely. So again, we'll go back to this, and let's say now we say we want to invest in a large, because just investing in mid and small cap initially when you're starting out may not be the best idea. So you start with a large cap, then you also explore large and mid cap. So your investment is into two categories now, large and mid cap, and we don't even know the names of the fund, right? So we simply type in large and mid, and we'll
Got
get
it.
some mutual funds, right? And we can select any. So let's say we go for this one, right? And again, we'll be able to see more names when we go to the peers. And later on, let's say you come across a mutual fund, your friend comes across a mutual fund, you get to know about it. You can do all these analysis just to find out whether the fund is worthy of your money or not. And it's a simple analysis. So let's do that. Okay. So large cap and mid cap fund, last 3 years return have been brilliant. Last 1 month, you don't have to look at such a small period. Let's look at last 1 year, 5 years. So yeah, pretty good, right? 15, 17%. But yeah, for a mid cap, I would want slightly better returns, because if I put my money in large cap, it'll be able to give me 15, 16%. Markets have been able to give 15, 16% return. So we are taking higher risk. So we want slightly more returns as well. But yeah, let's find out whether other funds are able to do this or not. Okay. So here it's beating the market, the average, right? Last 5 years, let's see if it's able to beat that. Yeah, it has been able to beat that. You see that the graph is higher, so which is good. The risk would always be high, so it should not really be causing any trouble. But yeah, this is an important page, peer comparison. So large and mid cap here in the last 1 year has been able to deliver 23%. HDFC has been able to do better, but then again, our goal is not to chase the highest return, right? Its expense ratio is also a little bit lower. So let's look at more. 3 years return, 30%, quite comparable with others, which is pretty okay. Last 5 years return, again, pretty comparable with others. That's nice. Last 7 years return, let's see if it has. Yes, it has. Again, we have Mirai giving better returns, right? And it's charging way too less as well, right? So now you get to see the difference here. So this is doing better, this is giving average return. If Nifty is able to give this much return, 15% over 5, 7, 10 years, Sensex has been able to give this return. So we want slightly better returns. And I think this is fitting the bill, right? It's charging less as well, right? So we can go here and analyze this fund because it kind of looks better. And that's how you can actually start to filter down better quality funds, right? So we have one large cap. I'm not suggesting maybe you do your own research as well, but Nippon, we have I kind of identified could be the one that can do the job for us. And then we are looking at this fund, right? Let's look at this one, and let's directly go here and compare it with others. Let's say the last 7 years return, pretty good. Let's say if we have a 10 years period return, and yeah, it's shining through, right? 25% in the last 10 years. That's pretty impressive. And it's charging less as well. So yeah, probably this could be another fund that is worthy of getting my money. If you
Wow,
are
it's only
investing,
3 minutes, Modit, and you're already at the expense ratio, which is criteria number 5. This is crazy. And I think you've also looked at the open ended. I don't know.
yeah, this is open ended only. We can have a
Right.
look. Yeah, it is open ended only, right? So yeah, open ended fund. And now
Yes.
at the fund manager, the
Yeah, the
returns
final
in.
criteria, the fund manager's reputation,
Yeah,
if I may say.
yeah, and it's so simple. We don't have to make it complicated. Look at this. Ankit is doing it, and go through his interview if you want to go through some of the other schemes that he's looking at. Let's say we look at this mid cap, the pure mid cap fund. Let's see how well he's been able to do. Right. Again, we simply go to peer comparison just to get a feel of how. And I think it was launched recently. Let's have a look. Yeah, it was launched uh, recently. It was launched in 2019. So we won't be able to analyze this much
That's right.
because the market went down and then everything went up from there. So it won't be a fair comparison. If you really want to find out whether the fund is doing well, look at 5 years or more kind of a performance, and then you get an idea. Because 5, 7 years would include good times, will include extremely bad times, and that's where you'll be able to find out whether the fund is doing well in good and bad times, and
Wow.
on average whether it's been able to give you good returns. But
Amazing, amazing. Modit, that was just wonderful. Actually, you said 5 minutes, but within 4 minutes, you were able to cover all the 7 criterias, which is just superb, extraordinary. All of you type in amazing in the chat window if you saw him go through those 7 points within 4 minutes for a mid cap fund over there. That was just amazing. How many of you promise that you will implement this? You will practice this a little bit tonight, because remember what he said in the beginning, it's learnable. I don't know whether it's 100% easy in the beginning, but it's definitely learnable. You can learn this, you can practice this, you can get good at it over a period of time. So, Modit, thank you so much for spending this time with us and teaching us this amazing stuff. I know you charge crazy amount of money for people to learn this kind of business with you so that they can not only make a little bit money, but even target financial freedom. And I know that's why the name of your company is Freedom Investors Hub, and you're the founder of that company. So, if
yeah.
anybody had to really learn this from you in the long term, is it really possible for people like me who are new to stocks and like starting from scratch? Can we really learn from you about stocks, about mutual funds, and growing over a period of, let's say, 6 months, 8 months, and becoming financially free by investing for long term money, maybe even short term to some extent? Is that possible?
Absolutely, yes. So mutual fund is the first step. When when somebody's stepping into the stock market for wealth creation and they know nothing about it, maybe mutual funds is the best bet for them. They don't
Wow.
have money, they don't have time right now to manage the money. It's okay, you can start with mutual fund, but that's not the only thing. You can learn more and you'll be able to earn more as well. So
Wow.
yeah, I do have sessions on not just the mutual fund investment, but for people who are serious about wealth creation. So I
Wow.
teach them how to select the companies, how to invest in companies, build a portfolio, generate a regular monthly income on it. And later on you can also learn about other things like technical analysis. You can learn about
Wow.
future and options, all that. I've been doing that for a very
So
long
even if I
time.
don't have any background in all of this, is it still easy to learn from your lessons, or is it like only for mathematicians, or like I have to be from accounts background or something like that? Because I'm not so educated. Will I be able to pick it up?
Well, I'll tell you. So I told you that in about 5 minutes you'll be able to, select mutual fund. Now I'll tell you, in
Good
order to
point.
learn and master the stock market, all you have to do is just learn every day for 15 minutes. And if you have zero knowledge and you learn just for 15 minutes a day, in about a month's time you'll be able to know everything about the stock market, about
Wow.
investments, how stock market works. And you'll be able to filter down good companies. You'll be able to filter down the time that is that you can invest, where you can
Wow.
get better return. Otherwise 15-17% is what the market has given, and if you just
Amazing.
invest wisely, you'll be able to get more than 15-17, upwards of 20%.
Amazing. So learn more to earn more. I love that logo of yours. I think I'm going to steal that. You should actually have kept it as become part of your company logo by now. Awesome. So how many of you want Modit sir back again on YouTube Live one more time for another question answer session maybe later? If yes, type in yes in the chat window. And we have something very special for you. As you heard right now, Modit sir said to us that he does run a course. And we have something special for you because today is 1st of August. It's an auspicious day. So, what we have for you here is a very special opportunity where you can learn how to attract passive income by not only investing in the right mutual funds, but now you can learn the entire stock market investments course, which is a very powerful course that Modit sir teaches. The link to that course right now is below on the screen. It's called miteshkhatri.com/freedom. The best part is that today Modit sir is willing to give us a discount on that course by using the coupon code that you see over there that shows Moon. So let me just show you once how does this work? How does the coupon code work? Okay, so I'm going to open up this on my screen right now and try to share the link with you right now. So here we go. All right.
Right.
I'm trying
And
to share my screen. Let's see if this works.
sure. And the one thing that I'll tell you is that uh, the you'll get courses, and there's live class every Wednesday. So if you
Right.
join in, there will be a live class every Wednesday that you'll be part of, so that we can connect
Wow.
live like right now, and we'll keep learning, we'll keep analyzing what the markets are doing, and whether right now does it make sense for us to invest, or it's better to wait. Where are the opportunities? All that we learn, right? And it's all about.
Amazing.
Okay,
Amazing.
there you go.
So here is the screen, guys. And if you click on this coupon code button here and just type in Moon, Moon, because today is full moon. So Indu decided it's going to be Moon is going to be the coupon code. And just hit apply. And it didn't work. So maybe type MOON. Yeah, it works. So capital MOON, just hit Moon and then you'll see apply 6995, which means the entire course will now become 2000 rupees less for you. So thank you so much, Modit, for giving us that special discount. Those of you who want to take advantage of that, I understand this coupon code will work for us tonight till about 12 o'clock. So all of you take advantage of this tonight during the full moon night. Before we go, Modit, thank you. This is a lot in very little time. One of my commitments to people when we teach law of attraction is to be able to learn a lot, achieve a lot in less time. That's why, even as you know, my platinum membership logo is achieve 10 years of success in 1 year. And that's why, thanks to you, we have your course in the platinum membership completely free. And I think a lot of people know that because some platinum members are actually attending this live YouTube live right now with us. But you actually made it happen. Something which is a very complicated topic, like a mutual fund topic, you actually taught us 7 simple criterias which we can use in just 5 minutes to make a decision. And I think I can be pretty confident right now that I'll make the right decision because there is data involved. It's on
Yep.
website, and I know that I've got long-term data to say whether I'm making the right or the informed decision. I wouldn't say right, but I'd say at least the informed, correct decision based on my knowledge, not just blindly investing based on somebody else's point of view, which can be a relationship manager or a bank manager. So thank you so much, Modit. This means a lot to me that you've taken time. I know it's like what 5:30 there in the morning now. It's time for you to go. So everyone, please say thank you. And as we always do, let's also say thank you and love you to Modit. We always say this when we close any of our calls. So Modit, anything you want to say to people about this investments course, about this world of investments before you leave? Because there's so much, if I may use the word, anxiety around this whole area of investments and stock market and all. So what advice would you give to people before you go?
Yeah, see, the anxiety will only come down if we have the knowledge. Because the reason why we are anxious and we are worried is because if we do not have the right knowledge, driving a car, if you do not know how to drive a car and somebody asks you to drive a car, of course you'll be
Oh,
full of fear.
yeah,
However, once you've learned it, you don't even realize that you're driving, right? It's same for investing as well. If you
makes sense.
learn what you're doing, you will easily be able to do it. The only thing that you need to put in is some effort, a long term perspective, and investing in a staggered manner. And knowledge, of course. If you have the knowledge, you'll be able to navigate ups and downs, and in fact be able to invest more because you know that you're investing in the right things. Then you'll be able to invest more when the market is down, when everyone else is fearful. You will be able to make the right decision.
I
That
love
comes
that
with,
point of view. I love that
yeah.
point of view. The more we learn, the more confidence we gain. And your point is very valid. Driving is actually a very dangerous activity. I could hit somebody, I could kill somebody. And that is why people have a lot of anxiety before we learn how to drive. But the more we learn driving, now it has actually come to a point where we drive, we ride a bike, and we don't even realize, for that matter, walking on the road is dangerous. But now that we've learned it, the anxiety is gone around it because we know what we're doing. Wow,
Yeah.
that makes a lot of sense. If that makes a lot of sense to you, all of you who are watching right now, and if you'd love to be part of a beautiful course, and the reason I recommend Modit sir is if you heard him talking, look at his energy, calm. Like one of the things I really like about Modit sir is very calm about money, not super excited because he never recommends people to take crazy risks with money. In fact, if you go through his course, he'll always tell you again, don't be stupid about money. That's one of the acronym he always talks about. You'll learn more about it when you go into the course. But really, don't be stupid about money. Be smart. And one of the ways to be smart is by first learn. So I personally learn with him, Indu learns with him, and I look forward to learning and practicing this with all of you. Let's grow our wealth. Let's learn together. Let's grow together. Thank you again, Modit. Yes, Indu.
Thank
Put the link in the chat window. Okay, so Indu just reminded me to put the link in the chat window. Okay, so here we go, guys. I'm giving you the link in the chat window for those of you who didn't get it. And here we go. So this is the link. And along with the link, I'm also giving you the coupon code, which is M capital OON. And here we go. I'm also going to pin this. Yeah, I think it's already pinned. So you will be able to see this, the latest message right now. Just click on this. Later on the video below in the description also, you might find the link. Click on it. Join Modit Sir's course. Let's learn together. Let's grow together. Let's make some financial freedom happen. Thank you, Modit, for that last piece of advice. I loved it. Thank you. Have a great day over there in New Zealand. Looking forward to see you soon in the next YouTube live.
Absolutely. Thank you so much, guys. Take care. Bye bye.
Thank you, everyone. Bye bye. Love you.